Morning, everyone. Thanks for joining. Thanks very much. Dialed into our webinar sessions previously, and if you're new, then welcome. We are looking forward to this morning's presentation, which will be Daniel Casali at Evelyn, and today he will be talking about the amid a sort of myriad of geopolitical tensions at the moment. So it's going to be quite an interesting topic. Looking forward to today. We've got the usual format. If you've dialed in before, you'll be familiar with it. So there's a Q&A button at the bottom, and we would encourage you to listen as we go along. Drop any questions that you might have in the Q&A section, and we will have some time at the end. So Daniel will present for about 25-30 minutes, and then at the end we'll have some time for your questions. So make sure you submit any questions you have on the Q&A button at the bottom there. So without further delay, I think we've got most people sort of dialed in. Thank you very much for your time and to today's.
Okay, thanks for the introduction there, Linda. So I've been, just a little background about myself. I've been covering strategy now really for 30 years. And today I'm really going to talk about how we can diversify the diversifiers amid all these geopolitical tensions. So at the moment, we've got demands for higher defense spending coming from Trump. We've got concerns about Ukraine, but there might be a deal in place to get a truce. We've got tariffs going on from the US side. So there's lots and lots of geopolitical tensions going on. So the key questions we're going to ask here is, how would you diversify that risk within a portfolio? And it's not just about bonds. There are other ways, probably a better way to diversify some of that risk. And we're going to delve into that in a little bit more detail. First, here's some important information that you'll see. And I'm just going to talk about the current picture here. And the basic point here is really that investors need to tailor their portfolio diversifiers with the type of risk that you probably expect. And I'm going to split this presentation to 4 bits. One is looking at the current picture. Second is the geopolitical risks. Then I'm going to look at some potential tail risk scenarios and also looking at how you can diversify portfolios. I just want to give the example here why it's so important to tailor the portfolio diversifiers with the type of risk. So if you went back to 2022, this was when we had an inflation surge in the year before and into early 22. And that's when the Federal Reserve and other central banks started to raise rates quite aggressively. This was the highest inflation rate for like 40 years. And the point here was that investors were all on the same side of a single trade. And that was that they're holding longer duration bonds, but they're also holding tech sector stocks as well. And they weren't particularly hedged at all. And the one asset that really did insulate or reduce some of that downside protection was really gold. There was other areas that done all right in that one, and that was energy stocks, because this was an energy related theme because we had the Russian invasion of Ukraine. But the point here is investors need to be mindful of the type of risks entailed and also to hold the right diversifiers accordingly. Just give me some examples. If you do have an oil shock for multi-asset portfolios, gold gives some diversification in a multi-asset portfolio. Also, inflation protected bonds, they capture some of this inflation surprise, and also cash. If you do have an oil shock, you can have diversification within the equity bucket of your portfolio, but just holding more energy and material stocks within the equity bucket that you hold. Rising geopolitical tensions, you probably have to hold a little bit more gold. And in terms of recession, if there's a recession, you probably want to hold more government bonds specifically for that risk. So I'm just going to go into a little bit more detail on some of the geopolitical risks. And when we talk about geopolitical risks, we're really just talking about US and China. And what I'm going to do here is just highlight 3 geopolitical hotspots. The first one is the Ukraine and Russian war. I think the best way to describe this is really, when we had the problems, it's really split about the voting pattern and linguistics. Here's a map that looks at the election results from 2010 and where the protests were. and you can see that the pro-Russian presidential candidate Yanukovych, he curried favour with a lot of the Russian-speaking parts of the eastern and southern part of the Ukraine, and the northern and western part was from Tymoshenko, who was the pro-EU candidate. And if you were to overlay onto this map the linguistics, who are Ukrainian speaking and who are Russian speaking, you can see that there's a clear connection here. And what this shows you is that Russia and Ukraine can really be split down the line of linguistics. And indeed, that's what we're likely to see over the coming months. We already see on the table a likely situation where Trump has excluded the EU and is just dealing direct with Putin and even excluded the Ukraine. So what we are likely to see is some sort of truce where there'll be some sort of demarcation line that splits the country, not necessarily along these sort of boundaries. It just means the Donbass and the Luhansk looks to be split in favour and given to Russia. Indeed, it's part of Russia at the moment. But the point here is it may be an uneasy truce, but there's plenty of examples around the world. Korea is still technically at war, and you can look at Cyprus, that's already split. And if you ever go to Nicosia, you have UN troops there. But what we're saying here is that this is a hot spot, but it's actually starting to ease. It looks likely we're going to have a truce, but it'll be an uneasy truce. Ukraine won't be part of NATO, and it'll lose some of its territory. That's the reality of where we're heading towards. In terms of the next geopolitical hotspot, it's really about the Middle East. I think the key area to watch there is really about Iran, and particularly the Straits of Hormuz. If the Iranians were to ever mine the Straits of Hormuz, they've done this before about 20 years ago, that would shut in a lot of the energy supply that comes from the Persian Gulf. So Iraq, Kuwait, they wouldn't be able to get their oil and gas out along with Qatar and UAE. And that would, given that 20% of seaborne oil and seaborne gas comes out of the Straits of Hormuz, this would have a significant impact on the supply of energy into the rest of the world. We already have a situation where the Houthi rebels are bombing or sending missiles into the Gulf of Aden. And also we have some pirating going on there. But there's a way around that. You can divert traffic around South Africa or into the Red Sea and through the Suez Canal. Certainly the Saudis are getting their oil out through the Red Sea that way. But this is a key risk for the world if we were to have a significant disruption in energy supply coming out of the Middle East. But we do know that with the fall of Assad in Syria, it means that the tensions between maybe Iran and Israel could be relaxed a little bit. It just means that Iran can transfer less weapons and materials to its allies in Lebanon or in Gaza. So maybe that'd be enough to appease Netanyahu in Israel. In terms of Trump, he's got this peace through strength. These were these comments you said way back in 2018. But what he is giving a message is that if you try anything, and this is straight out of the Nixon book in the 1970s, he tries his madman approach where he tries to show he's unpredictable and dare anyone to try and go against him. And this is certainly a message that will be given to the Iranians. What he's likely to do is slap on more sanctions against Tehran. He'd done that in his first term, and he's likely to do that again. He's likely to try and stop the transfer of money going into Tehran, and that might be enough to appease the Israelis and stop the Iranians from attacking Israel and vice versa. I think the big unpredictable one is really about the Pacific. Since 2011, when Obama had the pivot to Asia, so US interests are really centered in Asia. This does involve China and particularly Taiwan. Taiwan has got two strategic importance. One, it's a major, well, it's the big manufacturer of a lot of these high-tech chips. 90% of the high-tech chips that NVIDIA produce are made by TSMC in Taiwan. Yes, SMC is trying to open up plants in America, but not going to be operational until at least 2028. But the second point is that Taiwan is slap bang in the middle of this first island chain. So this is where a lot of the imports into China come through the Straits of Taiwan, and also Japan imports 80% of its trade through the Straits of Taiwan too. So it was paramount importance. But where Taiwan does figure geographically and its importance to the US is it has listening posts. It's very hilly if you ever go to Taiwan, and it looks down in China into the lowlands and see what it's up to. So Taiwan has got significant interests geopolitically because of its geography, and in a way, this is a way for the US to contain China so it doesn't move out into the Western Pacific. Of course, China wants to move out into the Western Pacifics. And one thing I remember, I spent 9 years in Hong Kong, and I just took this picture. And one thing that really annoyed the Chinese was that the Americans would roll in their aircraft carriers like the USS George Washington into Victoria Harbour in Hong Kong just to show that they had got a presence. And what the Chinese want is the Americans out of their backyard. So it's a bit of give and take in this one, but the big geopolitical risk really would be if President Xi would give the go-ahead to occupy Taiwan. I think that's the key risk for markets at the moment, and how that would impact markets, because it would stop the supply of technology going to some of the big tech companies in the US. Of course, that would involve a huge amount of risk for President Xi in China. Automatically, China would be seen as a pariah. It'd lose access to its treasuries. This is a big risk for him to take, but this is one risk that would keep us up at night. In terms of hedging this geopolitical risk, the BRICS are looking to try and have their own currency. And this is the heart of this BRICS. The BRICS stand for Brazil, Russia, India, China, and South Africa. They've added some other major energy producers like Iran and UAE to this grouping, but it's a very disparate group. They all have different interests. So it's not exactly unity within them. So, for example, India wants to play both sides, be part of the BRICS, and also be an ally of the West as well. But we did see last year where President Putin in Kazan, they've launched this symbolic note, it's not really functional, of this BRICS currency. But this really is where China really wants to upend the dollar financial system, because they're completely subject to this and they want to have their own currency at some point. But of course, to do that, it's going to take a long period of time, and it's starting to buy a lot more gold, because at the end of the day, they probably want to have a gold-backed currency. If you look at China, it's looking at its ownership of treasury securities. It continues to fall. It's been declined since the global financial crisis of 2008, and that's because the Federal Reserve started to buy a lot more treasuries. But since the Russian invasion of Ukraine, it continues to fall, because if you think about it, when a lot of the Russian FX reserves were confiscated by the West, the last thing the Chinese want to own is more and more treasuries, for the fear that there could be secondary sanctions and that those treasuries could be confiscated. So what does this all mean in terms of tail risk scenarios? Two areas to watch out for is really about energy and tech. One thing to look at is energy prices. So this looks at the price of crude oil. There's been a couple of spikes in the crude oil price. One was in 2008. There's lots of different factors going on that drove that. Iraqi saboteurs, there's an oil worker strike in Nigeria, and Venezuela embargoing ExxonMobil in terms of oil supply. And then, of course, you had in February 22, the Russian invasion of Ukraine. So we do have these spikes in oil prices. So what we did look at is, if you looked at a typical portfolio, and one of the areas in 2008, there was a lot of concerns about an energy shortage. You might have read Matt Simmons' book, Twilight in the Desert, and that was the thesis. Of course, that was proved to be wrong. But if you look at energy, how it affects portfolios, we looked at two different portfolios, looking at various asset classes, and we looked at 2008 and 2022. These are two periods where we had spikes in oil prices, and then we looked at the average. And what you can clearly see is that the areas that do well is really gold. UK linkers, so inflation protected bonds, do a little bit better in that sort of environment. And then the worst performers, things like real estate, for example, where there's less liquidity in that sort of area, and it's much more sensitive to the oil prices. But generally, we see that portfolios tend to do worse when you have these oil spikes. Investors don't like that uncertainty, and just as there is some indiscriminate selling. But what they should be owning is much more gold, and maybe anything that's connected to inflation, like inflation protected bonds. Another way to protect portfolios and diversify those risks is owning within your equity bucket to have a lot more energy, and indeed that helped the UK in 2022. It was the best performing major market. It had its biggest outperforming to the World ex UK for 31 years. And the reason for that was that it had a lot of energy within the makeup of its stock market. So energy, as you'd expect, with energy prices going up like crude oil, they have better earnings and they do a lot better. There's not much else that does better in that environment. You could look at materials that do better as well in absolute terms, and certainly relatively. But there's a lot of rate sensitive areas there that do worse. So discretionary, if you have to spend more on energy, that means there's less money to be spent on discretionary items. So that would probably do a lot worse. This is just looking at it historically. Another area to watch out for, and that was that third geopolitical risk to highlight, which was that if China was to invade Taiwan and cut off the supply on those high-end chips. This chart here looks at supply and demand of those chips. On the y-axis, we look at the customers' facilities exposure to China, where they actually produce the chips, and then the supply facilities exposure to China as well. And what you can see is Chinese companies such as Tencent, Broadcom, Nvidia, a lot of their demand and supply is really in that top right quadrant. So these are quite vulnerable stocks. So I think if you're looking at tech supply being disrupted, you probably have to look at it on a stock by stock basis to capture that tail risk. But the bottom line is that if there was ever that Chinese invasion of Taiwan, the tech sector would probably be significantly impacted under that scenario. Right, so how to diversify portfolios. The first thing is really owning gold. There's a new secular source of demand coming through. And that's really, if we look at central bank gold demand, it really started to accelerate from the global financial crisis. As I said, after Lehman's Federal Reserve started to do quantitative easing, gold demand started to increase. But also, since the Russian invasion of Ukraine, we've now had 3 consecutive years, 22, 23, and 24, where we've got over 1,000 tons of demand by central banks. And just to give you a flavour of that, that's basically a quarter of each year's mine supply. And given that China's the biggest producer, it means less supply of gold is coming onto the market, hence why gold price continues to rise. The reason why central banks are buying more and more gold is because they fear about these sanctions that are applied to Russia after the Russian invasion of Ukraine could be applied to them. That's why they want to own more gold physically within their own borders that they can control. And of course, there's the big structural argument with the BRICS, in that eventually China wants to have or the BRICS countries want to have their own currency down the road, and that would be gold backed. In terms of the private sector, they too are starting to buy into the gold story. We've seen the US that we see Costco, a retailer, also retailer, they're actually selling these Vraskin gold bars to the retail sector. And in China, we now have something called these gold beans. So each of these gold beans is worth about a gram. Weighs about a gram and is valued about $80 to $90. This has several advantages. One, it keeps you out of the clutches of the Chinese Communist Party. Also, it's another way to diversify assets. So, for example, in China, we can see that property prices have really been tanking over the last 5-10 years or so. We also see that the Chinese equity market has been quite volatile of late, although it has recovered recently. So maybe gold is one area where the Chinese consumers want to buy, and it's a way to immunize or insulate their portfolios to some degree. In terms of portfolio diversification, what we've done here is really looking at gold as a diversifier. So what we have is we're looking at gold where we add increments of 2.5 percentage points to gold, and in a portfolio of 65% equity, 35% bonds, we can see what sort of impact it has to annualized returns, and also standard deviation. Standard deviation, which is volatility, it does go down. And if you look at the annualized return, it goes up. So it actually diversifies your portfolio if you start to add more and more gold into your portfolio. If you want to own equities, this is one way to actually immunize yourself to geopolitical risk. When we see these geopolitics, it does have an impact in the short term, potentially. It depends on the type of geopolitical risk. You can see that here. So what we've done is we listed a lot of the major sort of events over history and looked at the S&P forward returns, how they performed over the week, month or 6 months. And generally, it's not that much. It doesn't have an impact. Things like company earnings or interest rates have a much more bigger impact than geopolitical risk. So the idea here is just to look through the sort of Daily Mail, Sky News headlines and just own equities through these events, but own a little bit more gold in your portfolio. In terms of our overall conclusions, we do think that you need to tailor your portfolio diversifiers with the type of risk. You've got to be mindful of these risks. They can be related to oil shocks, tech shocks that disrupt supply. You've got to be wary about where you think the risks are coming from, and also if there's a global recession coming through, that would be an obvious one for nominal conventional bonds. But if you think that there's geopolitical tensions likely to continue, remember we've got this secular demand driver coming from essentially geopolitics, which is creating a source of demand for gold. So I don't know about the rabbit and the magician there, but I think the trick here for fund managers is trying to understand what you're actually buying in terms of a portfolio diversifier and looking at the potential risks you're expecting. So maybe I'll leave it there, Steve and Linda, see if there's any questions.
Thank you so much for that. Really, really interesting. Some really good graphs as well and slides, which we will send out to everyone afterwards as well. And the one that I was interested the most in was the jars of gold, and the Jen said interest in it. I need to be aware of this because I'm sure my teenagers will be asking for jars of gold in the future.
Either that or Bitcoin. That's what my youngest is asking for. So.
Questions in as you would anticipate. One of the sort of themes or one of the questions is with regards to the relationship between US and what's next there. I know you don't have a crystal ball, but it would be interesting to get a view on that sort of China.
You were just breaking up there, Linda. Was it the relationship between China and US?
Yeah, so that relationship.
Yeah, I think there's likely to be a pivotal moment coming up in the next couple of months, and that's going to be a Trump meeting with Xi in Beijing. Trump has already said before his inaugurations he wants to meet Xi. Wall Street Journal is listing that it likely be in the first 100 days. And I think Trump is using his tariff increases as a bargaining chip really with China. And he's going to continue to use that as the art of the deal. But what Trump needs and demands is Trump has a wish list as well. What he really wants the Chinese to do is to buy more treasuries. And I think what he is doing at the moment is laying out a peace deal between Russia and Ukraine. Actually, he's excluding Ukraine and the EU to get this deal done. And what he really wants to do is to weaken or drive a wedge between the close relationship that we've had between Russia and China. They've got this no limits partnership, and he wants Russia to come back on his side a little bit. And he's just setting out the scene here to weaken some of the financial sanctions against Russia so that Russia can buy more treasuries. So what Trump is going to do in this summit is real Achilles heel for his MAGA policies. Is he needs he's going to have budget deficit for as long as we can see, and he's going to bring tax cuts, and he needs the emerging economies to start buying more treasuries. So it's in Trump's interest to work with China to have some sort of symbiotic relationship going on here. Xi's going to want some demands as well, but I think the key one would be for Trump not to raise tariffs, and the US is his biggest customer. It needs to be on board with that one. But it depends on the outcome of the meeting. It's not just about trade. There are other things that could be discussed, like the Panama Canal. Trump wants control of that. He obviously doesn't like that the Chinese control both ends of it. There's other things like he wants Chinese investment into the US. That could be easy to do for China. Tell BYD, a battery manufacturer, to invest in the US. Another thorny issue is about renminbi. That's the Chinese currency. Trump wants a weaker dollar, so he wants the renminbi to appreciate. He also wants the yen to appreciate, but that will put downward pressure on its export or lessen the competitiveness of some Chinese exports. So I think she will try and get his pound of flesh out of Trump with that one. So there's a lot to discuss here in this meeting, how this pans out. And again, it hasn't actually been announced, but it is coming. But that could be a sort of pivotal moment. We might get something like a Mar-a-Lago Accord, where we have some agreement, and you have to go back to the mid-1980s for the Plaza Accord, which led to the dollar coming down and yen going up. But something similar for China. But China be cognizant that it doesn't want to give too much away. But let's see what happens. I'd love to be a fly on the wall there.
Yeah, no, it's going to be very interesting. So we'll have to keep our eye out on when that happens, and it'll be, with this background knowledge that you've sort of provided today, it's going to be really useful to sort of watch that space, basically.
Sure.
Yeah, there's a couple of other questions that have come in. So one of the questions is, what do you think are the key risk factors investors should monitor over the next 12 to 18 months? It is war, is it trade tariffs, is it these?
I'd move a little bit away from some of the geopolitics. I mean, I've set the scene out here for the major issues about China and the US. I'd focus a little bit more on the fundamentals, and the big concern would be, and again, it's slightly connected to China, is about the AI theme. This has been the key driver of markets the last couple of years. Nvidia has got its earnings announced tonight. So at the moment, there doesn't seem to be any sort of reduction in spending by the hyperscalers requiring these chips, spending loads of money on AI. But then we saw the Chinese deliberately releasing DeepSeek ahead of this potential summit to show that it's not just about the US and their technology. China's got technology as well. And we saw deliberately President Xi shaking hands with Jack Ma of Alibaba, showing that now there's some favoritism shown by China for its tech industry. This is all directed at the US. So for me, I would focus a lot more on the AI theme, looking at those company earnings. Is there still strong demand for these high-end chips? That would be the main thing I'd be looking at for, along with other company earnings. So long as the US economy does not go into a recession, this generally looks good. And what we do know is that if you look at profit margins, they've never been higher. Since the pandemic, profit margins have hit record high, and there's a strong reason for that. And that, again, that's related to big data. Some of you might realize this, that when you look at this big data and when you're doing searches on the internet, companies using big data to try and squeeze out the optimal price that you will pay. So if you go into a shop, there's one price for everybody. Everybody knows what it is. But if you go online and you try and buy BA website or something, you get different prices. The wife and I certainly noticed that one. So delete your cookies in that one, because they will try and see what the optimal price you will pay. And the big data is being used to optimize profit margins. This is the key thing for big companies. So you don't need to grow fast. You can grow 2 to 3%. And that's what the US is doing. But with profit margins where they are, they're able to squeeze out more and more profits. One other thing to watch out for is interest rates and inflation. At the moment, the Federal Reserve seems a little bit relaxed about this. It's still expected to cut rates, same for Bank of England and ECB. But if there was to be a surge of inflation, that would be a key concern, particularly for the rate-sensitive areas of the market like technology. So for me, move a little bit away from the geopolitics, focus on the fundamentals. The AI is the big theme at the moment. Company earnings and those profit margins, rates and inflation. Those are the three things investors really should be looking at. And I know the geopolitics will all be front page all the time, but it doesn't matter as much in markets. And I've got my investors hat on here.
No, definitely. And sort of along that theme, then there's another question with regards to markets, global markets, and in particular with government bonds remaining a strong diversifier despite inflation concerns. So, are there any other global markets where the government bonds can still work?
Yeah, I mean, like I said, the key point about the presentation is actually understanding what the risks are out there and having tailoring the portfolio diversifier with the appropriate risk. So if you believe that there's likely to be a recession, say in the US, then you probably want to own government bonds because they'll probably do a lot better in that environment. If you believe it's an oil shock, you probably want to own more gold and maybe anything sensitive to inflation, which might be UK linkers, for example. So it's a case of not just thinking bonds is a hold all for everything. It may not. And the example I gave was at the start of the presentation is 2022. Investors were caught off guard thinking that actually they got a portfolio diversifier, but it didn't work. To give you an idea, in the UK, for example, 30-year gilt, which was considered to be a real portfolio diversifier, at one point, this was during the Liz Truss debacle, it actually sold less than Bitcoin. So to say that it fully diversifies your portfolio would be wrong to say that. And of course, that was due to the higher inflation, and then Liz Truss ignored the OBR. There was lots of individual idiosyncratic risks with that one, but it's about telling the right sort of portfolio diversifier with the right risks.
And then just the sort of final question, just to sort of summarize that. So obviously gold was mentioned in the presentation, which lots of people commented on how interesting that was and in a really good sort of under the bonnet view of that. But are there any underutilized or emerging asset classes that you think investors should also be looking at aside from gold?
I haven't covered it here, but there are some other portfolio diversifiers like property, for example, real assets. But you've got to be cognizant about liquidity. It may not be that liquid. So there could be periods where it's gated and you won't be able to get your assets out. So you've got to be cognizant of that. There are hedge funds. It's another way to diversify portfolio. That's relying on hedge fund managers to spot these risks and do the job for you. So those are a couple of other areas that could be considered as well. But I think another area where you can diversify that risk is actually within the equity bucket, buying particular sectors. So, for example, if you perceive that the Middle East, there's going to be some serious problems there and oil supply will be disrupted, you can easily diversify that by buying more energy stocks. But again, it's tailoring the risk to the right diversifier. Of course, if you had a crystal ball to spot all this, you'd be great, but nobody does.
Well, that was really interesting. I'm looking forward to having another look through some of those slides myself. And thank you so much,
No
Daniel,
problem. Happy to help.
for your time today, and yeah, a really interesting presentation and lots to take away for everyone. We will be sending out a copy of the slides also, so look out for that in your inboxes. And our next webinar, which follows on nicely from what you've just been touching on there, Daniel, will be on the 25th of March. And that's with New Horizon, and they will be talking about AI and sort of developing that theme on AI. So the webinar invite will be in our next Pulse newsletter. So if you just take a look out for that and register. But all that remains is for me to thank you all for taking the time to join us today.
Thank you.
Thank you, Daniel, and the team at Evelyn for supporting the event as well, and for your really interesting insights. It's been a really good presentation today, and thank you so much for your time, everyone, and enjoy the rest of your day. Thank you so much.
Thank you.